If you ever said to yourself, I don't know where my money went, or I'll start saving next month, or better yet, I make good money, but I don't know where my money is going, then this video is for you. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your money and live smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And be sure to check out the blog site where we post every Monday, Wednesday, and Friday. Today, we're talking about financial triggers, the emotional patterns driving your money decisions. As a CPA, I've seen this repeatedly. So, what is a financial trigger? Let's say two people making the same income, but one builds wealth while the other stays stuck. So, what's the difference between the two? Behavior. Financial triggers are emotional reactions that influence your money decisions. Often they're subconsciously showing up in stress, fear, guilt, comparison, celebration, scarcity mindset. Money is emotional before it's mathematical. Your money habits were likely formed long before your first paycheck. Financial triggers come from a multitude of different places, such as if you grew up in a financially stable household, was money never discussed with your parents or your guardian? Did spending equal love in your household? These early patterns shape adult behavior. If money felt unsafe, you may avoid it. If money felt scarce, you may overspend when you finally have it. Awareness is step one. Emotional spending, avoiding viewing your bank account, ignoring any tax notices, selling investments during a dip, and undercharging your clients if you have a business is how signs that you may be triggered and how it shows up. If you're a business owner, there's especially struggles here. You may avoid raising your rates out of fear that you're running your clients away due to scarcity of money. You may even be fear to hiring people because you may not think that you need the help or don't know how to ask for help. Or you may overspend in high income months. Emotions create inconsistency. Now that we know what a financial trigger is, how it shows up, where it may have came from, let's talk about how we can fix it. To fixing our financial triggers is to identify what triggers you. You're going to want to track those emotional purchases. Maybe you want to reflect on those financial mistakes that you may have made, but don't beat yourself up too much. You're still human. Notice the physical reaction you get when you make those purchases. Does it make you sad? Does it make you happy? And then the biggest thing is you're going to want to journal those financial stressors. Even not just the bad, because I know a lot of times we get fixated on that, but also the good. Sometimes people spend money on things that make them, when they're happy and they're overjoyed, maybe you got that bonus, or maybe you got that raise at the job, or maybe you heard some really good news and now you just want to go and spend. So this is the first thing we want to do is identify your triggers. Now that we've identified what those triggers are financially, here are some practical steps in order to help avoid them or fix them really. First, we're going to want to track purchases for 30, those emotional purchases for 30 days. Remember, you're going to want to track the good things that make you feel good, things that make you feel overjoyed, things that make you feel happy that you wanted to go out and spend money, as well as those that made you feel bad, something that made you feel sad, something that made you feel angry. We're going to want to track both because we want to understand what emotions trigger us to make those purchases. Next, you may want to implement a 24-hour rule. So if there's something that you have in your cart, this is really good for online shopping. Put something in your cart and then stop, pause, and come back the next day after 24 hours has passed to ask yourself, is this an emotional purchase? How was I feeling the day before when I put this in my cart and was ready to buy? Or is it really something that I truly need? And I just want to go back to tracking that emotional purchases. After those 30 days, you're going to want to take a look and see the type of purchases that you have made, whether they made you feel good or bad. So that way you can figure out what emotions trigger you to make that spending or investment opportunity. And number three is going to be to automate your savings and taxes. The taxes is more so if you know you're going to owe taxes at the end of the year, or if you're a business owner and you know you're going to have to pay taxes at the end of the year. So you're going to want to automate it because when you automate, it takes the emotions right out of any financial decision. So make sure to automate as much as you can. And then you're going to want to schedule weekly money meetings. This could be by yourself for about no more than 20 minutes. That's all you really need. Just check in with yourself, and it's going to help you check in with your emotions to see what did you do right and what maybe we need to improve going into a new week. And then lastly, maybe you're going to want to set up and work with a professional such as a CPA for accountability to help coach you and guide you through some of those financial triggers that may be holding you back. Setting up a financial system for yourself helps you protect yourself from yourself. So, why does setting up a financial system matter? Remember, income alone doesn't solve behavior. You really have to get to the core of what behavior drives those decisions financially. And you can make all the money in the world, but it means nothing if you don't understand what triggers you. Emotional discipline builds wealth. A lot of times, when you look at people who have already made it or are ultra wealthy, they tend to be able to control their emotions. They don't get too high when the markets are doing really well, and they don't get too low when the markets are tanking. They're pretty much even Steven. They stay very even kill. And that's the way you have to be when you're making financial decisions. You may not ever become ultra wealthy, but it can help you from living a life of misery and regret if you're able to control and discipline your emotions. Consistency reduces stress. Part of that consistency is what we're talking about, automating your bills, automating your savings. Helping to do that helps you to build that discipline. Discipline is built through consistent, redundant behavior. And this, again, reduces that stress of making a decision that you may regret later or something that really you didn't need at the time because you weren't in tune with how you were feeling. And awareness creates financial control. You cannot control everything that happens. You can't control if the car breaks down. You can't control if your barber goes up in its prices and what's going on with gas prices. But what you can control is awareness. And awareness helps you to make better decisions and takes a lot of the emotions out of those decisions. So, this is why creating a financial system helps you protect yourself from yourself. So, our final thoughts. Remember, wealth is built through awareness, discipline, systems, and accountability. If you don't address the emotional patterns, higher income won't fix the financial stress. But when you understand your triggers, you gain self-control. Wealth building isn't about perfection, it's about awareness and consistency. If this video helped you out, be sure to hit the like button and subscribe for more financial guidance from a licensed CPA. And be sure to tune in next week where we'll talk about taking a financial detox.